Hello, everybody, and welcome to the NextGen Planners podcast. My name is Dan, and I'm the head of community experience here at NextGen Planners. And today, I'm very, very, very happy to be joined by the wonderful Mr. Charlie Parker from Albemarle Street Partners. How are you doing today, Charlie?
Very good. Now I've been called wonderful. Thank you very much.
I usually like to charm people in the first.
And then at the end of the podcast, that's when you move in for the kill.
Yeah, it gets off to a good start. It does. So, I mean, it's true though. It is true. So, for anyone who doesn't know Charlie, he is the managing director at Albemarle Street Partners, and these guys are doing some really cool things in investment management at the moment. And he's also got an interesting story as well. So, to kick things off, Charlie, but as we do with everyone, can you just tell us a little bit about what it is that you get up to on a daily basis?
Yeah, so we work with independent firms of IFAs and financial planners who want to kind of do their own thing, be independent, but want some help running the investments. So we run discretionary portfolios for them, but kind of a bit more than that, try and support them across their businesses to help them grow. And so my day is spent talking to advisors, finding out what their knotty problems are within their businesses, and to the best of my ability, such as it is, trying to help.
Talking to advisors all day. What could be better? That's not taking the mick, by the way. That's what I do every day as well.
I love talking to advisors because they're proper businessmen, and having spent a lot of years in the city talking to people who, sit in offices earning salaries, it's been fantastic. Just meeting lots of people who are just, they're in their local communities, they're dug in, and they're going to figure out how to build a business come hell or high water. And I've got massive, massive respect for it.
Yeah, absolutely. Great stuff. Sounds absolutely fantastic. So we'll get into more about what it is like in specifics about what you guys do later on in the podcast. But I think in this episode we're going to go all over the place really, because you've got obviously experience, a vast amount of experience in this profession, but also a certain opinion on things. Given that you were at Citywire for a while as well, so it's a really good opportunity today to talk a bit about more the wider issues out there in the world rather than just sticking to financial planning. And the biggest issue that certainly our country is facing at the moment, I mean, in terms of economics, certainly is, of course, inflation. And we record this on the 20th of September 2022. Mm-hmm. So if you're listening to this in 2 years' time, hopefully it'll be a bit better by then. We don't know, though. But I guess, like, just from your perspective, how big an impact are you seeing on this having on people's lives, not just people's lives, but their portfolios, their financial plans, their relationships with advisors? What effects are you seeing at the moment?
I think, one of the things I'm really conscious on this is that we haven't talked much about inflation for the last decade because it wasn't around. But if you think about our parents and our grandparents, their whole lives, inflation was one of the biggest things happening in their lives. It was affecting every decision they made about what they wanted to do with their lives, how they built their businesses, how they raised their families, how much risk they took in their finances, how much risk they took in every life choice that they made. And more than that, inflation it's sort of at the scene of the crime every time something major has gone wrong for humanity. I mean, it really is as blunt as that. Every war, every famine, every persecution, inflation's been there. So it's kind of it's like a monster under the bed that has had a massive impact on everything, but has been quiet for a long time and has kind of reared its head. So as you suggest, it will have a huge impact in every single aspect of what we do. It will change, I think, the investments that work and those that don't work. And I think means that the stuff that worked over the last decade probably won't work in the next decade. And, any investment process built on past performance, forget it, because it was a fundamentally different environment. It will obviously change things for ordinary folk who, I don't think there's been another time where people are just as scared as they are right now. And we have to acknowledge that that's really real. And then, thinking about running a business, well, the way I think about it is this, for that 10-year period up until the end of 2021, if you're an IFA and you had a good client list, you had 50, 100 clients that you took really good care of and they didn't leave, markets went up every year, inflation didn't go up, your take-home pay, basically in real terms, went up every year. The money you took back to your family just gradually went up. If you stood still and you did it competently, your take-home pay just went up every year. Well, that stopped. Now, if you just just cultivate the same client base, probably markets are not going to go up very much. Inflation's going to go up a lot, and your take-home pay is going down in real terms. And we've got very used to it going up in real terms every year. So I think we'll have to think about that in all sorts of ways. We're going to have more dynamic new business strategies. And we're also going to have to think about those things that we do within our businesses that we kind of in our heart of hearts know don't really make us money, but we kind of wanted to carry on for whatever reason, didn't want to, turn that stone over. Well, those kind of marginal things, they'll now become much more important. They'll now become a much bigger drag on the kind of financial health of advisory businesses. So it's everywhere. It's in everything, and we're kind of programmed as human beings to believe that disruption won't affect us. Very, very good at spotting how change will affect other people, but we've got like hundreds of psychological biases stopping us acknowledging it in ourselves. So it will get into everything, and probably the challenge for us is, get real about the fact that we're not immune.
Yeah, really interesting perspectives. I think that one of the things I thought whilst you were talking is the idea that like this is a bit different to educate clients on, because when you're educating clients about investing, you can get the 150-year chart out and say, look, it's always gone down, but it's always came back up again, and it's always gone down. Inflation's happened loads of times in the past, and it's been there for a long time, but it's not as stable as investment growth. Like it usually it hangs around for a bit longer than you think it's going to, or it hangs around for a little bit shorter, or no one can explain where it's going to go or how it's going to go, or how fast it's going to go. And I think that makes it a little bit more difficult for advisors to educate their clients on it. And certainly with like things like assumptions and stuff like that, like we asked in our community how many people are changing their assumptions for their cash flow models based on what inflation is at the moment. And it was really mixed. And when something's really mixed like that, it proves that it's a bit of a difficult thing to try and get your head around and educate people on as well.
Yeah, and I think how do you approach that? Well, you can put in a number you make up. Like you can say, well, I think inflation will be 5% for 10 years. But the thing is, it's sort of, if it is 5% for 10 years, then we're going to have so many other sort of problems in life that it probably won't almost matter, because it'll have such a systemic negative effect on global growth. I think my approach to that is to basically take government policy as my baseline for assumptions. I don't think you can do anything else. And I also think you've got to remember that these kind of moments of acute worry and acute stress, people love to say, like, sort of compete with each other to say the most negative and the most bearish thing, because you sound clever if you say something negative. Like if you say, well, these central banks, they haven't got a clue what they're grappling with, they'll discover soon how, then you sound shrewd. If you say, no, there's a lot of clever people bringing inflation down, ultimately they'll probably be successful, well, then you sound naive.
It's boring.
But actually, that's just a behavioral bias like every other. It's driven by our desire not to look silly by being overly optimistic. But my view on it is that whilst this inflation is really unpleasant, the periods that we are comparing it to, like the 1970s, were actually very, very different to now. I mean, we had central banks that were not independent. We had 20 years of persistent inflation that had got into people's bones, like into the culture of society in a way that it just hadn't now. And, to my mind, they probably will bring inflation down. And I think in the United States, we've already seen this start to happen. Yes, it will take longer than the most optimistic people think, and there will be bumps along the way. But I do fundamentally think that ultimately they will crack the problem. So when you're planning as an advisor for the long term, I think the main thing, the main challenge is to say, well, in these 1-2 year periods where inflation is at 10%, you're not going to beat it. Like no one is going to beat it. Just be honest. Nobody is going to beat that. You can shop around for a better investment manager, try and pick a better fund, forget it. No one's going to beat inflation. But if you kind of fundamentally believe that on the long term, order will be restored, then you can trust those long-term numbers. Then you can trust that equity risk premium to eventually basically work and basically get you to where you need to be. But I think you have to kind of be able to diagnose the differences between now and that 1970s period, which is what we will hark back to, isn't it, as well? What if it's like the 1970s?
Mm-hmm. It's really interesting. And I'm just thinking out loud here, because this again comes back to one of the points that you mentioned before about you said that financial advice businesses are going to have to do things that they don't like doing or that they've done in the past just to be nice or whatever, but it doesn't really make commercial sense. And I'm just completely thinking out loud here, by the way. This could come out absolutely as absolute garbage, but like we saw what happened during the coronavirus pandemic, that it forced us to innovate a little bit. Well, a huge amount, in fact, because this whole thing of online meetings is just one of examples. For instance, like it forced everyone to at least build in online meetings into their strategy. And what that did is it allowed people to scale, because they don't have to now spend 2.5 hours each way traveling to see a client. They can just do it online. It's not exactly the same, but it still gets the job done. And that forced us to innovate a little bit. So my question here is, my question was going to be, what advice would you give businesses like to run a business whilst going through inflation? And I think I'll attach onto that question of, do you think that this will force something like that, will force businesses to innovate because they're now having to make basically better decisions because inflation is causing profits to go down or whatever it is?
Yeah, I agree. It's a creative, destructive process. It does force us to address things. I'm always very reluctant to tell advisors how to run their businesses, because my experience is that all businesses are different and everyone has their own weird way of doing things, and that they actually work really well. And then when big companies try and hoover them up and gobble them up, they sort of stop working, despite the best laid sort of strategic thinking and all of that, because it is a local community thing, advice, in my view. But that with that proviso, that apology said, I think I'd say a couple of things. You won't know whether the activity you're doing is profitable unless you actually price everything, the time involved, the cost you associate with it. That doesn't mean you'll end up cutting things. It might mean that you end up actually looking at some of the support staff within your business who are actually doing this work and putting a price on their time, start charging for their time, for example. So all of these processes are really important. The other thing I'd say is that, if we're saying that probably to get the sort of growth that we hope to get in real terms in an inflationary environment is going to require us to go out there and probably win some business. Now's the moment to put together a new business plan. Start with a P&L plan for the next 5 years that builds in some growth. Don't sit there being so cautious about it that you don't plumb any into your thinking. Get some into your thinking, and that often concentrates the mind about where you're then going to find it from. And then kind of in terms of, what sort of innovation does it cause? Well, I think the obvious answer is there are going to have to be some aspects of what we do that have to be automated or semi-automated. And I actually think that this is a fantastic opportunity for local advisory businesses, because we've had 10 years where we've been told that we are being stalked by these mega robot advisors who are going to take over. Well, they haven't. Like there's robot butlers we were told we'd get on when we were kids on Tomorrow's World. They don't appear, right? They aren't making any money. They're losing money hand over fist. Local advisors are still making money. But all these robot advisors, they are creating really useful technology. And I think one of the things that we'll see in our industry is that as interest rates go up, it gets much harder for people to support these technology providers, these robot advisors financially, for the venture capitalists, because higher interest rates means those firms have got to produce higher returns to be worthwhile for these venture capitalists. And they're going to start looking for ways to monetize the work that they've done and the innovation that they've done. And they're going to look at the local advice sector. They're going to look at ordinary financial advisors, these people that they call dinosaurs, because they're going to go, hang on a minute, you guys have actually got a bit of distribution. Maybe if I can get some little bits of robot advice, meeting little segments of your client base, or even broadening the offering you have, doing things that otherwise you can't make money out of, but you could if it was automated, then actually that might start to get some revenue into our technology business. And for advisors, I think it means that we're actually potentially on the cusp of a really exciting period of development where we will have on offer for local businesses a whole range of clever bits of off-the-shelf kit that can put efficiencies into our businesses, but can also move it into new areas and into different areas we hadn't even imagined being able to support clients in. So that's, that kind of vaguely answers your question. I think what will happen is, that stuff will get pushed at advisors because of high interest rates, and that gives advisors an opportunity to grab hold of it.
Really interesting. So yes, was the answer to like whether it's going to. it's really interesting to hear you say that. What was it you said about creative destruction? Was it creative destruction or something like that?
Yeah, creative destruction. Yeah,
that's really cool.
Joseph Schumpeter.
Yeah, I've never heard that before. I'm picking up things all the time after 100 episodes of this podcast. And you mentioned when you were talking at the start about the fact that like financial planning firms, and in that answer there, you were saying like financial planning firms have always made money. We've had, how many bits of disruption have we had in the last 100 years? We've had we've had a world war, we've had 2 world wars, no, 1 world war now, a Cold War, we've had inflation going mad, we've had a massive pandemic, and pretty much through all of them, I mean, I don't know, I wasn't around 100 years ago, but pretty much through all of them, financial planning and financial advice has been a kind of stable money making career.
It has. I mean, remarkably stable. There's a bit of research by a French economist called Thomas Papillon, which has produced this brilliant graph. I'm sure we can put it up somewhere for people. And it does do 100 years of data. And what it looks at is what's the percentage of people's savings that financial intermediaries have taken each year for the last 100 years. So obviously, kind of what a financial intermediary is has changed. It was stockbrokers, and then it was IFAs, and now fund managers are in the mix, and everyone else. But it's been almost exactly 2% for 100 years. I mean, it is absolutely remarkable.
How
stable that if you like, that take has been for financial intermediation, which is why everyone hates us, by the way.
I was literally thinking that
whatever you throw at us, we always get paid, and obviously added an enormous amount of value for that. But there's only really been 2 episodes where people have taken more than 2%, actually. One was in the years before the Great Depression, when stocks were going up 1,000% a week, so no one cared if they paid their stockbroker 20% or whatever. And the other was just before the tech bubble in the early noughties, where again there was so much growth that everyone thought it would carry on forever, and so no one cared what the price they paid was. But other than those 2 episodes, and they came down very quickly from those 2 episodes, it's been about 2%. But in the middle of that, I don't want to bore you all stupid, but I think there are like 4 massive disruptions that, if you like, IFAs and the predecessors to IFAs have experienced. And now I've said this before, I've got to remember all 4. So, the first one was that after the Great Depression, they fixed the price of trading commission for shares. They did this to protect consumers, thought they'd been gouged in the Great Depression. And that lasted from the late 1920s to 1976 in America, 1985 in the UK. And actually, of course, it didn't help consumers because they fixed the price incredibly high. So that, by the 70s in America, you were paying $200 to trade a share in 1970s money, which is a massive amount of money. Then they unfreeze the price of trading a share in the mid-70s because people wanted to put their prices up, of course. That's why they unfreezed it, because they lobbied the government because they wanted to put their prices up, but actually it didn't work. People like Charles Schwab in the United States and Hargreaves Lansdown in the UK came along, absolutely dumped the prices. And so that within 10 years from the mid-70s to the mid-80s to the mid-90s in the UK, the amount of money you made from trading shares went down 90%. So that whole industry is just gone. So what did IFAs do? Well, they went, right, I won't trade you a share. I'll buy you a product instead. And this was better for consumers. Buying a unit-linked bond from Allied Dunbar, it's got problems. Buying a mutual fund's got problems. You paid a lot of upfront commission, all the rest of it, but it was a heck of a lot better than someone churning shares for a living. So a big progress, but of course that got hugely disrupted by the internet. People will now get you invested in a fund basically for free. So that experienced nearly 100% disruption event. Commission disappears. The money you get paid for buying a fund disappears in the kind of mid to late 90s. And then I think we kind of went into phase 3, which was, well, okay, I can't make any money trading shares. I can't make any money just selling a product. I'll get you diversified. That's what I'll do. I'll get you diversified. Now, I would argue that phase has also had a massive revenue disruption affected. It just IFAs have been kind of cushioned from it because fund managers and DFMs took the pain. They moved from active funds to passive funds and saw, maybe a 75% drop in costs, or they moved from a bespoke DFM charging 1% to a managed portfolio service charging 25 basis points. So another huge disruption. And then we come to the kind of 4th, phase in the evolution, which is, well, all right, the value of just getting someone diversified, that can now be done very cheaply. So I will do more than that. I will get you to your number. Like, I will get you to your goal. You tell me what you want to accomplish, and I will figure out how to get you the highest probability of getting to that goal. Now, you could say that robo-advisors will disrupt that. I think that's still quite a long way away. And I think a lot of advisors are still moving from just being people who get someone diversified to people who genuinely goal plan and build in the technology and the resources they need to goal plan. And I think the thing that will really protect advisors in this stage is the people that we were told are disrupting us actually really need us. They need our distribution. They need our relationships to make any money out of all this technology that they've built. So, I think that's all going to come in and protect advisors in this fourth phase. But the big takeaway is, they took our business model away 3 or 4 times, still here. And they're here because of relationships, nothing more and nothing else than relationships and a genuine belief that they want to help ordinary clients. And you will get a lot of IFAs out of their local. You will prize them out with a sort of screwdriver. You will not get local IFAs out of their communities, and it doesn't matter what technology you throw or what innovation you throw. And for me, it's one of the most remarkable things about the sector.
Wow, that's a really interesting step through history. I'm really interested to see what the next 100 years, because like now, for instance, 100 years is a long time, by the way, and I certainly don't intend on being here another 100 years time. But like, think about where financial planning is today, like how good it is today, and the great work that financial planners. It seems a bit weird to still call them financial intermediaries, because almost now the product is the financial planning. Yeah. And that's the bit that's most valuable to people. Yeah. And although products are still heavily involved in everything that financial planners do, it's not the main thing anymore. So it sounds a bit weird to describe them as financial intermediaries nowadays. And I think that's a good thing of where we've came from, actually.
Yeah. Look at the evolution of the people that have helped advisors in this country, right? So you go back 35 years, was it? You've got magazines like Money Marketing launched. They were the sellers of marketing and this, marketing stuff. Then you got, maybe 20 years ago, you've got magazines that you'll have heard of, like, Investment Week were all launched, and they were all about, we're a bit more sophisticated now. We're in the business of diversification. Then you got stuff I was involved in launching, like New Model Advisor, that moved much more towards let's talk about kind of planning at the center of what we do. And now we've almost moved a step beyond that with things like what you're doing with NextGen, because now it's not even about magazines that are a kind of vehicle for advertisers. Now it's there's a genuine element of collaboration now in community driving what connects IFAs together, and that I think just reflects that journey that the kind of profession has been on over that time.
Yeah, it's really good. And very, very kind of like, if you are an optimist, you're not struggling for material at the moment, because there's lots of great work going on out there at the moment.
But I do think, like, we've got the fundamental problem we've got about the future, in my view, is that we don't service enough people yet. Like, we not enough of the population is being helped. And I would also say a lot of people are not being helped with their biggest financial planning issues. So I would say, if you or I wrote down a list of the financial issues we've had to overcome in the last 10 years, I doubt many of us would put picking the optimal balanced fund for our pension very high. It's like, well, what about when I had to consolidate my credit cards? I had to decide whether to lease a car or buy a car. I had to get a mortgage. I had to get the kitchen done. I didn't know whether to take the loan from B&Q or whatever it is, right? It's like, this is the real stuff of life. This is the stuff that we all think about, argue with our wives, husbands about. This is the real stuff. And the bottom line is, there's been no model to monetize helping people with that stuff, not meaningfully. And okay, you can make some money out of mortgage advice, but you're not building value in your business in the way you do with investment advice. It's hard to put emphasis on it. And I do think that in order to move into all those areas, so firstly, maybe some of these robo technologies coming in will mean that, if you like, an ordinary financial planning practice that is making its money off a percentage of AUM, it's a great business model, but is able to also do some of this stuff, have a little application so that people can get the best car finance deal. And most of it is automated, but they can jump off if they need you, sort of thing. So we're able to just, like a spider, kind of reach out into a whole other range of stuff. But maybe if the technology is good enough, it also enables us to make what would be the kind of quantum leap in the profession, which would be if there was possible to have a planning model didn't just take a share of AUM, but took a share of people's income. If we were able to say, do you know what, I would pay 0.5% or 1% of my monthly income if, as a result of that, I knew I was getting a better mortgage deal, a better car finance deal. My credit card was always the best option, that I was always on the best energy tariff. That all of this stuff that is so important into broader, loan planning, all of that, to broader financial planning. Maybe if it could be a percentage of income, then it would move tens of millions of people that are otherwise couldn't make enough money for a financial planner to help into that area and into that realm where they would help. And that would be wonderful, because I think you'd still get higher net worth people, charging a percentage of AUM. I think that works very well, makes good money, but it would open up the possibility of monetizing all these other areas. And what my hope is that local businesses will be able to plug in stuff simply enough that those areas become things that they can engage with in their local communities. And we don't get into a kind of winner takes all thing where 2 or 3 of the largest players who want to kind of close the savings gap, close the advice gap, just kind of have a naval race for technology and end up hoovering up loads and loads of people. I hope that local advisory firms can kind of play a step in that next phase.
Yeah, it's so true. And also, I think a lot of this stuff is coming certainly faster in the US. So there's a massive fixed fee movement going on in the US. I mean, it's in the UK as well. But like, I was speaking to someone recently on the podcast, for instance, and he was like, we don't just look at investment stuff. We look at how to negotiate a pay rise, or
yes, exactly.
how to buy your first home and all that kind of stuff, which financial planning is perfectly capable of doing. Yes. It's just that a lot of people pay for it through the investment route, like you said, and they're doing it in really, really cool ways in the US. And I think it's slow growth, but it's definitely being solved, which is good as well. And I think as well, when we think about that generation, because that advisor is working with I hate using those kind of bracket terms of millennials and Gen Z and all that kind of stuff, but he is working with those types of people.
What are you? What do you reckon you are?
I think I'm on the boundary of being millennial and Gen Z, which I honestly,
I'm not even quite. I'm just about breaking into millennial, but I don't think. I think when people look at me, they don't. This is not what they expect a millennial to.
That's being very harsh on yourself. So our generation of so if we say that generation of millennials and Gen Z, we've grown up. I mean, apart from the 2008 crisis, when we've had money, we've grown up during a period of time when it's been pretty good in terms of investing. Like you've got pretty good. Like it's been a bull market, hasn't it?
Yeah.
And actually, last year I found this stat out on a challenge that we were doing last week. Last year there was more money put into stocks and shares around the world than there's ever been.
Yeah.
I mean, obviously that's kind of going. It's obvious that that's going to happen if we in a capitalist economy, because we're just making more money. But like, it's changing now, I think, and it has changed over the last couple of years in terms of like there is talks of recession and inflation's up, and there's talks of a bear market and stuff like that. We don't really like to talk about this kind of stuff on this podcast. What I'm interested in is the psychological impacts of that. So like there's got to be impacts, for instance, of people who grew up in the 70s, had that massive inflation to deal with, and also low investment growth, and the psychology in their brains is therefore different to people who haven't grown up with that, who've grown up pretty comfortably.
I mean, in so many powerful ways. I mean, I always say that for me, the kind of cause, the underlying cause of the 1970s inflation, I think, was that after World War II, you'd had that generation of people, Americans call them the greatest generation, right? They've made these enormous sacrifices. And, you've got US presidents, British prime ministers who had to launch an unconditional war on poverty. Lyndon Johnson called it an unconditional war on poverty. In Britain, we built the NHS, they built Medicare, Medicaid, social services, better housing. We could not let that suffer because of the sacrifices they had made. And that kind of unconditional war on poverty lasted until 1980, basically, when it had also caused huge inflation. And you got kind of like a new settlement in society. And the settlement was, if I need to cause a recession to stop inflation, I will. You know, it's Paul Volcker, the US Federal Reserve chairman, who did that in 1979. And it set the grounds for 40 years of prosperity. You know, very low interest rates, really very low levels of volatility in inflation. For the whole of my life, that's been the situation until this challenge right now. And so those two halves, that kind of before Volcker and after Volcker, you know, before Volcker, there was a massive fear of debt. Because if you know that your interest rates can go from 2% to 15%, Volcker on one day raised rates by 5% in America. He pushed unemployment to 10% within a year. So a fear of debt that was absolutely in the core of everyone. It was particularly in the core of the working class. So there was a much smaller middle class and a much smaller affluent class, because of course if you're working class you would never get into debt to go to university because your fear of debt was so huge. And it's really that post-Volcker period where ordinary working class folk have been willing to take on debt because it seems that interest rates are very low and very stable, and so they've been willing to fund people through higher education, all these things that have been part of a kind of an equaling of society, but they're all made possible by very low interest rates and very low inflation. Now, we as a society have to work out what we want to together achieve if we are going to have to do it in the context of higher inflation. And there will be sacrifices involved in that. We're going to have to completely rethink our energy policy and move away from our reliance on a very small, number of countries. We probably have to rethink, as an industry, things like ESG. Are we ready to stop investment in gas and oil, given the geopolitical kind of chaos it's unleashed in the last year? Or do we have to, almost be less ambitious in the short term, more ambitious in the long term? It takes a world that seemed quite simple. The rules of finance were debt was cheap, growth always eventually came, you could leverage your way to a better life. It takes all of that apart, and it makes us rethink the rules and recognize how much more complicated the world can be to navigate as an ordinary person, financial world, and also how much more complicated the moral aspects of that can be to navigate.
I never actually thought about those kind of ethical issues coming into it as well. I was merely just kind of thinking of what impact that is going to, as maybe not my generation, because I think my probably psychology is ingrained in now. But like certainly people who are just perhaps leaving university nowadays, for instance, and they're just starting to make money, they're now going to come into a very different situation than what we've been used to in the past 20 or 30 years. And that's definitely going to have an impact on their future kind of psychology around investing in money and stuff like that.
I mean, I spoke to someone at the weekend who is a teacher, and they needed to reset a bit of their mortgage. And they sort of said to me, it rang me up, because I think you vaguely know something about finance and all of that experience. And said, should I take this deal or should I go onto a variable rate? It's £100 more a month. And they said, I haven't got £100 more a month. This just has been a very long time since that little seed of panic in people has been felt, for a generation, that inflation does cause panic. It causes that, oh my God, well, I've reset this 20% of my mortgage and the next bit has to be set in a year. And if that's 500 quid more, I can't live. And that this is a new thing. And I mean, we know that, obviously Liz Truss has sort of backed away on energy bills, but, people are going to be facing some incredibly hard choices. And I think for our profession, for the planning profession, we have to ask ourselves the question, how can we help? How can we help when we don't really have a business model at the moment that enables us to make money out of helping? And I think that's a powerful and an important question. I don't think I have the answer to it, but I hope that those of us who have been fortunate enough to make good money out of this profession, think about that in the next year or two and just put some time aside to how can we find a way to offer people a bit of support.
Yeah. Because
sorry, very bleak.
No, I think it's bleak optimism though, because I do agree with you that like at least we realize that there is a problem there. What is it? I can't even remember the figures, but a very, very, very small percentage of our population gets financial advice. I think it's certainly less than 10% of people get financial planning. Just think of the impacts that we could have on society if 10% more of our population got, even just 10% more of our population got financial planning. It'd be huge. And this kind of like gets on nicely to where I was thinking about going with this. We've talked about it a few. Well, you've mentioned it a few times. This kind of robo advice thing, which was the intentions were great. Which was that, I mean, there was a kind of like Sunday Uplands thing, wasn't it? Of like you, it's scalable for financial planning businesses because it means you don't have to be there all the time.
Yeah.
And it's great for consumers because it means that your costs therefore go down, and it also might offer them a better service. And I can remember when I came into finance in 2017, this was literally all anyone was talking
It was
about.
everywhere.
Like
It was
every
everywhere.
single presentation that I saw in 2017 pretty much was, are we going to be replaced by robots? That conversation's pretty much gone away now, because I think we've come up with a clear answer, and evidence has shown that it doesn't really go. It's not something to be that excited about. But I think a lot of excitement is shown recently towards this now hybrid, or people sometimes call it tech-enabled advice. They have this thing of, like you mentioned before, allowing automations to do all the boring stuff and using humans to do the stuff that they're great at, which is, well, most of us are great at, which is empathy and understanding someone's needs and desires and stuff like that. So maybe just a word from you on like the where you see hybrid advice going, and also like if that's potentially an answer to the advice gap that we're just talking about as well.
Well, I think it can be a massive kind of part of the answer. I think, what's happened between now and 2017 that's changed it. I think a couple of things. One, the pitch of robo-advice, standalone robo-advice, will be so much cheaper than face-to-face advice that it would be a no-brainer. The thing is, they're not. I mean, the big robo-advisors in the States, Betterment and Wealthify, that have got, they've been going for a long time and massive investment. These businesses started off charging 15 basis points, 25 basis points. Now they're up to like 35, 40. And a lot of the new guys are coming in at 50 because actually they said they could be 75, 80% cheaper, but no one made any money. So as it turns out, the pricing point was wrong. Now, when you're at 40 or 50, you're pretty flipping close to a real human being, aren't you? I mean, there's not a lot, that 10 basis point difference to liaise with a website versus a person doesn't feel like a lot. So I think that's what's changed in the last kind of 5 years. And I think that, the people who had backed those businesses, as I said earlier, are looking for little avenues to put these sort of micro journeys, if you like, of financial planning into local firms. Now, I suppose the banks could do it. But the problem with being a bank in Britain now is that, you're probably making more money from the same clients already than you'd make if you put them into a low-cost, cheap robo-advisor. So you've not got a huge incentive to do it with the high-value clients that you've got on your books. And you could say, well, okay, make a loss on it, but, get twice as big because you're the only people to do it. Except they can't get twice as big because they know full well that if Lloyds or, any of these big banks try and grow too much, the government will just squash them again because they don't want a monopoly. So they haven't really got an incentive to do it. Like the people with the real distribution, the mass distribution, haven't really got an incentive to do it. And all right, maybe sort of, insurance companies will do it at the edges, but I mean, they're not known for their dynamic implementation of technology, are they? Insurance companies. So I'm afraid it's the much maligned corner shop advisor is probably the best bet to get some of this technology out into the world on a bigger scale. And I also think, for a local advisory firm, for every kind of 65-year-old couple with a 400 grand portfolio, there's 6 or 7 other family members that could be reached if the technology, if the implementation was right, and if it was cost effective. And so whilst the local IFA movement still reaches a small amount of the population, if that movement was enabled with really easy to implement technology, you could easily, reach a multiple of people through that trust that has already been built as those relationships kind of filter out. I mean, that's my hope, but it obviously relies on firms being willing to implement the staff, to take it seriously, to not kind of brush aside the conversation, all this sort of stuff. But that's my hope anyway.
Interesting. I guess, you're exactly right. I think that's the thing I worry about most is the implementation of it. It's not so much the technology, it's the implementation of it in each financial planning firm that is the most kind of challenging.
I'm acutely aware, running my business, that if we want to be a provider for independent local firms, we're going to have to be a kind of curator of this technology, because otherwise the largest consolidators will all do it. And the independent firms just won't get access to it. And you know, one of my biggest frustrations with the advisory market is if you want to sell, you get a lot of help. If you want to stick it out alone, there's not a lot for you. I appreciate NextGen is trying to plug that gap, doing wonderful work doing it. And, you know, maybe you're also someone that could curate some of this technology, your movement. But I think we just, you know, we need to have forums and places where we look at all this different stuff, get together, appraise it, you know, prioritize it, work out what works and what doesn't work. Because otherwise it will all be done by the largest consolidators, and that'll be the only show in town. Like, I hope that's not what the future looks like, because I think, you know, Britain's made up of a lot of very different people, and they need very different advisors to reach them. And, you know, I hope that diversity can remain.
Yeah, absolutely. Yeah, I mean, that's so true actually as well. Like, that's one of the things I say most about NextGen is the diversity that's in there. You know, there's people who help kind of completely different communities in there, and it's lovely to see, and it's brilliant to see. So we don't want to lose that diversity. Just a few questions left, and these ones that we ask everyone. So we've kind of covered a lot of stuff, but I don't think I've asked you this overtly yet. So we ask everyone, what are you most excited to see in the world of financial planning? We said 100 years before, but let's bring that down. Let's just say 10 years. What are you most excited to see?
Well, I think that we've come out of a period of consolidation where everyone's been selling out, and I always find that a bit boring. But I think it's generally followed by a period where people decide to go out again. It's a kind of concertina-like thing. And I think the industry is at its kind of most fun when people are setting out to build businesses. And I think we're probably kind of moving into that phase again. I think, you know, as interest rates go up and some of these consolidators disappear and all the private equity money disappears, I think we'll see people launching businesses. And, you know, we've been working with some firms recently that have launched businesses, and they all come to us and say, you know, are you interested in working with us? We're just starting out. You know, we haven't got loads of money to move to you on day one. And we're like, 100%, because it is the most fun period. And so I hope we see that. I hope one consequence of higher rates is, you know, not everyone bails to these consolidators, and we see some people strike out on their own, and they're able to connect better now with, you know, communities like yours and others, and so find it a little bit easier, and it summons up a bit of courage in them to do it and to have a go.
Yeah, I definitely agree with that. That pattern actually. I think was it maybe 2 or 3 weeks ago now. I had like 3 or 4 conversations with financial planners who are launching their own financial planning firm in 1 week. And yeah, I mean, you know, usually it's maybe 1 every 2 weeks or something like that. So there definitely is a movement towards more people having their own advice firms. Which
I think people won't. I think the thing about that kind of consolidation thing slowing down is no one will realize it until it's happened, because there's still a lot of people making offers to IFAs. But every single recession, every single interest rate cycle has led to a massive decline in private equity money. And the thing about the private equity guys is they're going to be out there telling everyone they're in it for the long term until the phone just stops ringing, you know, they'll just disappear from the sector. And I think that's what we're kind of getting to now is you know, we're at the kind of end of that, and silly money being paid and all this stuff. And, you know, only the best quality businesses will get bought. And I kind of hope that meets a lot of people who had just sort of gone, oh, well, I'll just flog it. Instead, sit down and go, actually, I'm in this for another 10 years. Let's make this good. You know, and those are the people who kind of we find it exciting to work with.
Yeah, and those are the people who are going to make our profession not only better, but they're going to make it more diverse. They're going to bring more young people in, because if they are not hiring those young people to come into financial planning, who is?
Yeah.
So I mean, we've got academies and stuff like that out there. There's issues with all of them, but like independent firms have been the backbone of people coming into financial planning, and if they go away, then so does that kind of progression into financial planning.
Absolutely, and I think, you know, I think as well, you know, financial planning is a great profession to come into a bit later in life. You know, talking with someone last week, is giving up teaching to become an IFA, age 38, 39. Said, you know, I feel like I'm starting too late. I was actually starting a really good time. It's really tough.
Young, that's a young time.
21. You know, go and see these little boys and they look at you like you're a kid. You know, actually, it's a great age to start. And you've learned so much stuff in teaching about dealing with conflict and people and stuff. Brilliant. Get involved. And I think the same, particularly for women coming back into the workforce, there's some flexibility, and you can earn good money. You can get qualified relatively quickly if you really apply yourself. and you can work flexibly. So I agree, it's the independent firms that have the flexibility to bring really good quality people back into the workplace. But where is the independent? Where is the Academy for Independent Firms? How do we fund it? How do we put it together? That's, I think, one of the big questions that we've all got to kind of work out an answer to somehow together.
Yeah. It's called the NextGen Planners Training Contract, but that's enough sales for this podcast.
that's excellent then.
So we always like to ask all of our guests for a book or a piece of content or something that has helped them throughout their career, really left an impact on them. So what would you recommend that our guests consume?
Oh, okay. So I'll give you two. Can I give you two? Is that too much?
Yeah.
I think the best book I've ever read on economics is Why Nations Fail by Darren Okaneglu. And it just gives you a kind of methodology for understanding why some countries get rich and some countries get poor. So I'd read that. It's brilliant. And then the sort of Bible, if you like, for Albemarle, a book that we all pass around, is Factfulness, which is a book, and the Hans Rosling is the author, went for me for a second. And Factfulness is all about thinking in an evidence-based way about the world around you. It's got an incredibly positive message because it shows that for all the horrible things going on in the world, actually it's getting much, much better. And in the last 30 years, stat to finish on, famous Hans Rosling stat, in the last 30 years, the number of people in absolute poverty has halved, even though the population of the world has gone up massively. And it's a really edifying book, but also one that just says, just try and stick to facts, informing opinions, and life gets an awful lot easier.
Yeah, like the Bible of pragmatism, which is
exactly.
Like we kind of like, how many times have we heard people saying, "Oh, you need to go to this website. It's called the Happiness Project," or that, whatever it is. And there's always loads of heartwarming stories on there and stuff like that. And it is lovely and it's great to see. But like, that's a really interesting idea that you can read a book and then that changes your perspective on everything around you, which just makes you realize that everything is not as bad as actually you think it is. And a lot of people do gratitude, for instance. Gratitude exercises are amazing. Because how much stuff do we take for granted every single day? And that we know that gratitude makes us happier and stuff like that. So sounds like really good. I don't we've never had those two recommended on the podcast before. So there we go. Another one to add to the reading list for our audience. Fantastic. Cool. So I think we'll end it there, but that's been a really good conversation. It's been fantastic to chat with you today.
Can I get a hoodie now? Is there a free hoodie?
We might be able to make that happen.
I've definitely promised a hoodie.
We're about under promising and over delivering, so we definitely didn't promise that, but we will deliver. And it's not actually me who deals with the merch, it's Claire, so I'll pass it to her. She'll deal with it. But we do like to give the last word of our podcast to our wonderful guests for joining us on the podcast. So can you tell our audience where to find you, how to connect with you, and leave us with anything that you have to say as well?
Yeah, well, you can find us at aspim.co.uk. We'd love to chat with you. And other than that, keep the faith, keep going. You'll get through it together.
Great stuff. I didn't think this was going to turn into a TED talk, but it has. So that's good.
Maybe one of those like local TEDs that aren't quite as good. But
TEDx, yeah. Great stuff. Well, thank you very much for joining us today. So that was Charlie Parker on the NextGen Planners podcast. You can find this podcast on Spotify, Apple Podcasts, Google Podcasts, and on our website, which is nextgenplanners.co.uk. And on there, you'll find more information about all the cool things we're up to at NextGen, including the training contract, which we mentioned, our amazing community of over 800 financial service heroes, I refer to them as, and a couple of cool things that we're coming up with next year as well, including our conference. We'll actually be doing a crowdfund by the time this goes live, so you can get involved with that. And also a brand new tech product, which you'll be able to find on our website as well. And we are on social media, so please follow us on LinkedIn and all the usual places. And also, I always forget to ask this, but if you could just leave us a rate and a review, you have no idea how much that helps us to grow the podcast and get bigger, which is ultimately what we're all trying to do. But yeah, we'll leave it there. So thank you again so much to Charlie for joining us on today's show. Thank you guys for listening as always, and we'll see you in the next one. Bye-bye.